Okay, guys. Um, Most likely you watched the short-term trading video on the Market Maker series, and just to quickly summarize the things that we discussed in that particular tutorial, uh, because it's going to be germane to the discussion as it relates to day trading, my concepts. Now, short-term trading, the duration of the trade is anywhere between 1 to 5 days. Now, contrasting that with a day trade, obviously, as the name implies, it's a day trade. The trade that you take and execute an entry in the same day you enter, same day you exit. The approximate number of pips in a short-term trade is 50 to 150 pips. Intraday trades can range anywhere between 25 pips, 15 pips, as much as 100 pips. Okay, on a real big barn burner day, you can get over 100 pips or so, depending upon the type of magnitude and volatility that's available for that particular pair in that day. Optimal setups for short-term trading are in sync with the daily and 4 hour. Now you're going to see that the highest probability for successful day trades are going to be very similar to those conditions as well. And the time of day is sensitive for entry and exit, as you may have already expected. Now, the structure in which you work within to frame the ideas that you're either going to be buying or selling any of your pairs or asset classes, depending upon whatever market you're trading, because this is not limited to foreign exchange. But we start with the daily chart, and we're focusing more specifically on the daily for overall market structure, key support resistance, and institutional order flow as it relates to order blocks and liquidity voids and liquidity pools. The 4 hour, we're specifically looking at the daily and 4 hour order blocks and liquidity pools. Where are the stops? Because where the liquidity pools are, that's going to line up for your future turtle soup entries. And we'll talk more about that as we get into this particular teaching. And 15-minute is for timing. We were looking specifically at the time of day, ICT kill zones in the London Open, New York Open, and we're specifically aiming for first returns to the order block. That is the other trading pattern that we use. So we're limiting our trades to just two patterns. That is the turtle soup, false breaks, and the optimal trade entry return back to a order block for entry. All right, now for day trading, obviously you guys heard me talk about this many times in the past, and you're going to hear it again just because it's that good. When we look at a daily range, the daily range is going to be the primary decider on whether you're going to be a buyer or seller on a particular day. And the reason why is because the daily range is what you're trying to capitalize in. That's the nature of day trading. We do not like to force ourselves into creating a long-term trade out of a day trade. So if you're going in with just a day trader's mindset, um, expect to take the lion's portion of your trade's profits off at a pre-disclosed time, and that being the London close time period, specifically the 1500 to 1600 GMT. Okay, or I average anywhere between 10 o'clock in the morning to noon in New York time. Okay, so that's kind of like the sweet spot. I like taking my profits in the 10 o'clock to 11 o'clock in the morning hour in New York time. That's like, to me, that's where the actual high or low forms and then starts to have a little receding back into the range beyond that particular hour. Now, does it happen always? No, but by far and large, you're going to learn if you start studying the price of any asset, it's going to do that very thing. Now, your primary function as a day trader is to determine whether you're going to be a buyer or seller for the day. Now, I'm not talking about scalping. I'm not talking about going in there for 5 pips and 10 pips and 15 times a day. I'm teaching you how to load up and wait for specific times of the day where you get one shot, one kill intraday setups. You get one shot, one kill in London, you get one shot, one kill in New York. After that, you move to the sidelines and you wait for another day. If it doesn't set up a parameter for you to take another trade the following day, you sit and wait. Okay. Now, for a buying condition, obviously we expect the open to be very low in the lower quarter or 1/3 of the average daily range, and we expect the close to be higher than the open. Okay, that's all you need to be profitable in day trading. the amount of distance between the low and high is going to be very respective of the average daily range over the last 5 days. Now there's tools and indicators that are out there that are very easily found. I will be adding them to the tutorial page you viewed this tutorial in. At the bottom there's going to be a zip file, and I'm also going to have an individual itemized list. You can actually go in and pick the very one you want, so that way you don't have to go through the whole zip file. But I will create a zip file for everyone that has an interest in all the things I use for MT4. None of them were created by me. Okay, so these are all things that I've collected over my years in the foreign exchange, and I've got them all over the place. I can't really remember where I got everything from. Some of them are actually emailed to me by friends and subscribers to my group, and I'm very thankful for that. And some of them actually were created by some of my subscribers. So I'm gonna leave that for now. I would love to be able to find out who was the author and creator of some of them, because I want to give credit where credit is due. I don't want to assume or let anyone think that I created these things, because I did not make them at all. Okay, but I do find them valuable if I'm using them in my MT4 presentations. So now when we look at an open, high, low, close bar, okay, this is what I want you to think of, okay, because it's the accumulation, the profit release portion of the daily range, or the expansion up making the high, and then there is the distribution intraday. Well, when we see that, okay, that is very uh, predictable when it comes to trading price patterns. And one of the price patterns I love trading is turtle soup. Now, turtle soup, you hear me talk about a lot in my videos, is not a pattern that I created. It's not something I came up with individually. Years and years and years ago, I bought a book, as you can see here. It's titled Street Smarts by Larry Connors and Linda Raschke. And one of the patterns in their particular book I love very much. It's called turtle soup. I'm not going to go into details and steal the thunder from the book, but I will tell you this. It's a pattern that trades um, a break below a low. Okay, in other words, if it's a swing low around an area, near an area when you would expect a low to form, but not quite so uh, precise in terms of, for instance, if we had an order block just below the marketplace and it had already created a swing low and starts to turn around a little bit. What I like to do is I like to wait and see if that initial low is breached, and as soon as it's breached and trades into an order block on a higher time frame, I'm all over that bad boy on a day trade or a short-term trade. But specifically for day trading, if this occurs during a trading session like the London Open or the New York Open kill zone, as it relates to ICT concepts, that being London Open is 2 o'clock to 4 o'clock in the morning New York Standard Time. The extended ICT kill zone for London is 1 a.m. to 5 a.m. So you kind of bracket out those hours, but the sweet spot is generally between 3 o'clock in the morning to 4 o'clock in the morning. You'll find that that's many times at the very high or low of the day. New York Open is generally a condition in the market where you see a continuation of whatever was placed in the market directional wise in London. There's usually a continuation of that in New York. Now the times it's not going to be a continuation, when it gives you a reversal market profile, in other words, it may have moved like 60, 70, 80 pips in London and gave you a very nice sell-off or a rally, but then it hits a higher time frame order block. Then at that moment during New York Open, what will happen is you'll see a market reversal profile, and the market will turn on a dime and go back the other way, and many times retrace the entire London session move and go beyond it and go lower or higher in deference to initial London drop, and then the reversal in New York, creating a rally that goes beyond the high that was established in London. So that's why it's important you have a higher time frame um, respect of your charts, because if you don't keep that in mind, you're going to get nailed by these intraday market reversals. Now, as you can probably guess, the turtle soup on the reverse side is a break above the high, and we'll talk about that as we get to it. But most everyone that's familiar with my concepts in day trading, especially as it relates to foreign exchange, it's very systematic. Okay, it's very specific, and this is an old graphic I gave back in 2010 on my days in the Baby Pips forums when I was teaching there, and it is still true to this day, and it is the very, very concise way of viewing the London Open setup. Okay, generally you'll see at the beginning of the day there'll be consolidation 0 GMT, and there's consolidation going into around midnight New York time. And then what will happen as we approach Frankfurt, okay, around 1 o'clock in the morning, going into 2 o'clock in the morning New York time. So whenever I'm talking about New York time, unless I mention specifically GMT time, everything I say is New York based time. So everything that I do in my teachings, if you want to know what I mean, it's to set a time on a clock or a watch. Just buy a cheap old watch, okay, and keep it near your desk. And whatever time it is in deference to New York time, that's when you'll understand the ICT kill zone, okay? But generally around midnight in New York time, there is this initial move. Okay, if you're bullish, there'll be a drive lower moving down, and we call that a Judas price swing. Okay, you don't want to follow that, but you do want to anticipate it. Okay, because you don't want to follow it like the sheep. When this move drops down into what we have identified here as a previous important high or low, I gave indications earlier in 2010 that it could potentially be a previous daily low. It could be a previous daily New York low or a New York high. It could be a previous day's high. Okay, but most importantly, it's definitely going to be an order block of some kind or an important low intraday or a previous session. Okay, so in other words, it could go down and create a turtle soup buy. Okay, like we just disclosed a moment ago when we looked at this pattern here. Okay, we have a low, and then when that drive lower previous below that previous low, that drive lower where the star is, that may be occurring right at London. And you have that indication right here where you had the optimal trade entry, the OTE at the bottom. That may be the formation of the turtle soup. That's why I gave this idea, because I want you to kind of dovetail these pieces of the puzzle over the last 5 years I've been teaching all these things just in foreign exchange. I've taught rather these things in private groups and one-on-one sessions for a lot longer years. Okay, the only thing that I've added to my work here is the Asian range, which I was fortunate enough to glean that from Chris Laurie. Um, Asian range was not something I created. It's something that I employ because I saw value in it. I never noticed it, never paid any attention to it, never even realized it was there. But his work as it relates to his free tutorials and stuff you can get on chrislaurie.com, that website is loaded with all kinds of things, and he actually mentioned this in his teachings, and once I looked at it I saw value in it. As my days as a spooge trader, we used to trade Globex around midnight time frame, and what will happen is you would see the opening hour after midnight, so in other words midnight to 1 o'clock in the morning. It would create a very similar phenomenon to this. So once I understood what he said about the Asian range high and low, it was pretty synonymous to what you'd expect to see as the first hour trading range. It's violated, and same thing with day trading S&P during the intraday. You see that same phenomenon taking place. But the Asian range, we want to see it move down below that Asian range low, ideally. But you don't want to take any entries on a long that is above the Asian session high until it's New York time frame. Okay, in other words, the New York kill zone is an ideal area to take a long above the Asian range high. Okay, ideally you want to be entering below the Asian range high, and specifically the high end entries on probability will be at a level below the Asian session low. Okay, so you're going to be looking for a Judas swing moving lower, whether you're trading a return to a order block, a bullish order block, or if you're trading a turtle soup. Now turtle soup is 99% of the time what you're going to see in London open, because it's going to be reaching for a stop hunt. Okay, that's generally what happens in New York. I'm sorry, what happens in London. London Open is generally a run on stops. It's a false break, higher or lower. In this case, we're looking for a long. And once it goes down into that previous low and pierces it just a little bit, it could be 10 or 15. It could many times be just 1 pip. But if you get that in addition to a return to an order block, a bullish order block, whether it be on a 15-minute time frame, an hourly time frame, 4-hour time frame, even an hourly time frame, that will give you um, many times an outstanding entry. Okay, and then if you want to wait for a smaller short-term 5-minute optimal trade entry to form, you can do that. But in London, sometimes it doesn't form, guys, and it may just take off and you miss the boat. You'll have to end up waiting for another move. It takes place later in New York session. But when you enter on a long, okay, you want to have an average daily range or a projected high of the day. Okay, and there's many ways to do that. I have a tool that you can download from the tutorial page. It gives me an indication of where I could reasonably expect to see the average daily range high form for that day. And what I'll do is I wait for time and price to meet. So in other words, I have an idea where price should go on the ADR on a 5-day basis, and I wait for the daily range to expand. Now, I am not sitting in front of my charts. I used to do this, but I'm not sitting in front of my charts watching price go up and down because it'll drive you nuts. Once I put my entry in, I put my stop in, usually it's 30 pips, and then there it is, I take off. I don't check it until around 6 o'clock in the morning. So I try to get my sleep. Once my entry's in and once my stop's in, I don't really try to pay attention to it because if I watch it, I'll end up second guessing myself and get out of it. I'm human too. Okay, so the thing I've learned is this is turn the charts off. My stops are in, my limits are in. I just get out and leave it alone. It's either going to stop me out or it's going to move in my favor or go nowhere until London closes into New York. So what will happen is many times is the range, if I'm right, will expand to the upside. I'll wake up around 6 o'clock in the morning. Uh, that's about the time that London's having their lunch period and they're getting ready to cross over into New York session. Now, the New York session, again, we'll see generally a small little retracement. Okay, and that generally happens between 5:30 in the morning to 6:30 in the morning. That retracement, okay, sets up the New York session expansion continuation in the same direction it was set up by London Open. Okay, so if we're looking for London Open long, we're going to be looking for a continuation on the New York session. Again, expecting that ADR to be expanded on the daily range, upside met, okay, and then if it's in a very quick, fast market, it many times will go beyond the average daily range. But mostly, you're looking to take your profits at ADR and then move to the sideline. You can leave a little bit on the profits, leave a position on, like we were talking about with the short-term trading. You can leave, half on. You can leave a quarter on. You can leave, if you're really nuts about the trade and you think it's going to have some legs, you can take 25% of the trade off and let 75% stay on. I generally don't like to do that, but I like to get the lion's portion of the move out. Okay. Once the Asian session high is breached, okay, and your long has been entered and it's below the Asian session low, in other words, let's repeat that. Your entry is below the Asian session low and the market has moved beyond the Asian session high. Your stop needs to be absolutely at break even. You do not let it go back to a position where it could stop you out. If you do not do this, you're going to give up opportunities to either move to a break even or drive yourself nuts with needless risk. You don't need to do that, okay? But you're waiting for the daily range or the daily candle or bar to expand up, okay? Moving towards the 10 o'clock to 11 o'clock hour in New York time in the morning, okay? Because you want to give it time. So time and price is, if you get in the trade, you got to let the market move. Do not get in there and watch every 5 minutes seeing the candles moving up and down, gyrating. Don't let that shake you out. You have to literally turn the charts off and go away. Do something else. I know it's hard to do, but you're going to have to do that. And it took me years to get this where I just simply just let it happen. And yes, you're going to come back and see that it stopped you out. And then sometimes you're going to see that it stops you out and then moves in your favor. But guess what? That's part of trading. You're going to have those things. I have them. You can't escape it. You're not going to be perfect. Don't expect perfect. You don't demand perfect, and you won't be disappointed when you don't get it. Okay. So obviously, as it relates to selling short, we're looking for the same thing, just in reverse. We're looking for the high to form in London Open, okay, just a little bit above the opening price, and we're looking for an expansion on the daily candle or range to a lower close on the day. Okay, and the amount of distance between the high and the low is limited, okay, initially to the 5-day average daily range. Now, it's important that you understand that we're not trying to get every single pip. We're not trying to get every single penny that's available in the move. You're only looking for the lion's portion of the move. That's all you need. If you do this once a week, you've nailed it down. 25 to 30 pips a week, you absolutely can double your money every single year, regardless of how much money you have. If you start with $100, if you could double it every single year, in less than 15 years, bang, you got $1 million. Okay, I know it sounds incredible, but simply just do the math on it. If you can do it with a tax-free vehicle, it's it. You all can start with $100 and do more than anybody else would have ever imagined. You don't even need to double your money every year either. You can do 50% a year, okay, and do an astronomical amount of increase in your equity if you manage your money right. But looking at what we have here, the same thing is said in reverse. We look for a Judas swing Okay, and I did mention it earlier, but if you take the average daily range, okay, and you take the average daily range for the day you're getting ready to trade, okay, and you times that by 0.33, what that's going to give you is the very high end, high level that should form for the day. Okay, in other words, if you have an average daily range of 100 pips, it should be 33 pips from the opening price at midnight in New York time. Okay, or use the 5 GMT candle as a general rule of thumb. Use the opening price on that. Add 33 percent of whatever the average daily range on the last 5 days is. Add that to that opening price. Okay, and then whatever that level is, that's how far you're willing to see it rally up. Now, it doesn't have to go that high, guys. It does not have to rally that high. And for the buy signals, okay, like if we go back in discussion of buying the low in the London, it doesn't need to drop down 33 pips either. Okay, but you're allowing that much range. Okay, and the reason why is because it's about 1/3 of an average daily range of 100 pips. Now, it's not going to always be so precise, but you're going to see many times, if you look at it on an average basis over of the month, you're going to have about, nine, 8 to 9 really wonderful setups where it fits so perfectly like a glove. If you just traded one of them per week, you got it. You nailed it. Okay, just don't try to trade every single day. Now, looking at the level here that we have, it is a green level here. This is again the same graphic that I have from 2010. So 2010, we had all this framework given to you, and nothing has changed. Nothing has changed. The only thing we have learned is the precision components that make up what is that previous important high or low. It's an order block, a bearish order block. It's a previous day's low or previous day's high. It could be a previous day's New York session low or high, and it could be the previous day's ultimate high. Okay, so in other words, it could be a turtle soup based on that. Okay, so the Judas swing up, we're anticipating that. We're looking for it to be around 33% of whatever the last 5 days average daily range is, and you add that range to the opening price on the 5 GMT candle opening price, or whatever midnight time frame is on your platform. Okay, so there's two variables there, and I'll leave it to you to decide on which one you're going to use. It's not that big of a deal, guys. It's not going to, you're not splitting hairs here. It's not important. It's not that big of a deal, but I know a lot of guys argue with me about time, daylight savings time, and when should I move this, and I don't care about it really. I use 5 GMT candle, but only as recent I've been using the 4 GMT in my platform, because that is the actual 5, I'm sorry, it's the actual midnight candle in New York time, not specifically 5 GMT candle. But I use 5 GMT. If you have a gun to my head and ask me what I'm doing, that's what I'm doing, guys. I'm using the 5 GMT candle, and I'm adding the range to that. So I was trying to be diplomatic about the folks that want to argue about this daylight savings time. You have to include it. You don't have to include it. Whatever. I'm not going to beat that up. But the point is when we're selling the London Open, we're looking for that Judas swing to occur, and it's going to come in the form of a turtle soup sell, or it's going to come in the form of a return to an order block or bearish order block. And once that entry is formed, okay, if we see a move below the Asian session low or the Asian range low, once that happens, you need to put your stop loss to break even. Do not let your trade turn into a losing trade. Ideal entries are above the Asian range low, and specifically very high probability if it's entered above the Asian session high. If you get those parameters and you get turtle soup, or you get an order block that's bearish and trades up into it, and it runs up at about 30 pips, and the average, I'm sorry, if the daily institutional order flow is down, and I failed to mention this when we were talking about buys, if the institutional order flow on the daily chart is up, in other words, bullish order blocks are being respected, bearish order blocks are giving way, market structure is moving higher. Okay, and that sets the tone for your directional bias. You don't need the moving average crossovers. You don't need all that stuff. Okay, you just look at the price and see if the order blocks are breaking way and the buy order blocks are being supported. Institutional order flow is up, and then you look for the next range that it's going to reach to, the upper bearish order blocks or the highs to be broken, and that's what you're doing. The same thing we use for the short-term trading. It's the same components you use for your day trading model. Okay, all we're doing is moving down into a smaller time frame intraday. Now, once we have our position at break even, we're waiting for the daily candle to expand to the downside and create that large range day going down and have a lower close. Again, holding to 10 o'clock to 11 o'clock in the morning New York time. Okay, 1500 to 1600 GMT, that's kind of like when I'm looking for the low to form for that day. And you'll end up seeing that the lion's portion of the move, you can capture a good chunk of that. And you can be a little bit wrong in terms of your entry, and you can be a little bit early exiting. And in fact, I actually exit a lot earlier. If the average daily range is 100 pips, I'm getting out at 80. And I don't care. You guys can argue about it and say I missed the 200 pip range of the day. I don't care. Because if I'm doing it with the day trading model, I'm trading a day trading model. I'm not trying to turn it into a 6 month position. Okay. Again, the turtle soup sell is a pierce of an old high. Now, the high doesn't have to be limited to a certain number like they do in this book. They give you like a 20 or 21 day high, and it's based on the turtle trading pattern breakout. Um, it was a long-term breakout strategy, and it was less than 30% accurate. But because they had very good money management and they caught very, very long-term trends, it was profitable for them. So think about it. If they have less than 30% accuracy, good grief, that's better than 70% accuracy if you flip it and don't do what they're doing, and you sell the false breaks. Okay, in this case, selling a false breakout above an old high. And that condition is what you see 99% of the time in London Open. It's a turtle soup environment in London. It's a false break. Okay, there's many names that's been attributed to it. The Frankfurt Fakie, the false run, the London Lou. It's all kinds of different things have been tossed and given. But the long and short of it is, if you anticipate the movement, it doesn't matter what you call it. You don't have to call it a Judas swing if you don't like it. Just call it a false break high, okay, for a sell, or a false break low for a buy. But you're specifically looking for it to happen at London Open, and that's the time frame when the characteristics of intraday price action gives you the high or low of the day. Now, by itself, you have 80% of the daily expectancy figured out if you have higher level daily institutional order flow figured out. If we're moving higher or lower on a daily chart, only trade in that direction. Then, if you see the conditions we're talking about, if in this case here we're looking for a turtle soup sell, institutional order flow needs to be going lower. And for that to be in place, that means you're going to be seeing bearish order blocks being respected and bullish order blocks being broken on the daily chart. And if you want to qualify it with strength analysis, go into a 4-hour chart and see the same thing occurring. Bearish order blocks being respected and bullish order blocks on a 4-hour chart being broken. Okay, it means any orders that were resting to buy the market are not causing any rally in the marketplace. It's just eating right through them and just going lower. And that just tells you where the institutional hand is. It's on the heavy side. They're moving prices lower. And the same thing, just flip it for if you're looking for institutional order flow on the higher level that's moving higher, up on the daily chart. Go into a 4-hour chart, look for bullish order blocks on the 4-hour chart to be respected and bearish order blocks on the 4-hour chart giving way. And that'll apply strength analysis to your overall directional premise on the daily chart. And it just gives you a whole lot more confidence that you're trading really with the institutional order flow and sponsorship by the larger banks and the smart money. And again, going back to this example, we many times won't get the optimal trade entry. Okay, if you don't get that first return in an order block or that first pierce of an old high for a turtle soup, you may not get that 5-minute optimal trade entry that everyone expects. It may not happen, and if you do miss it, if it doesn't form and it starts to run, don't chase it. You look for a smaller mitigation block to trade into. If you understand what that is earlier in the series, okay, you'll understand exactly what I'm talking about. I'm not going to teach that here. But you'll have to wait for New York Open if you don't get very close to the high. If you start moving below the Asian session high, okay, don't take an entry with a whole lot of risk. It would be better actually if you waited to New York Open and take a trade at that time, because you've now missed the very low risk optimal entry. So now you're going to open yourself up for more risk, and it's not necessary. New York Open, if you're in a condition where you're looking for lower time frame, lower moves and higher time frame institutional order flow, the range will expand on the downside on the daily chart, or your daily bar will expand to the lower side, moving into that 10 o'clock to 11 o'clock morning time frame in New York. That's your profit taking hour. That's when you anticipate the low of the day forming. Going back to the high, we're expecting the high to form between 2 o'clock and 4 o'clock in the morning, New York time, and the low forming between 10 o'clock and 11 o'clock in the morning. I know this sounds amazing. It sounds phenomenal. It sounds like it can't be that easy, but that's exactly what your charts will show you if you go in and study it. Okay. Now, again, It's important that you understand that you don't have to get many of these setups a month to do very, very well. Focus on getting one per week in the beginning. Day trade it, paper trade it, you do it in your MT4 demo account. I'm not going to tell you when to start using real money. I don't ever tell anybody to do that because you'll know when you want to do it, okay? But I'm only teaching you techniques to trade and teach yourself using the very concepts that I do myself. Now, this is a pattern for intraday trading that will absolutely murder you if, number one, you don't know what's happening. Sometimes it will catch you. But if you're expecting the first week of trading to be a trending market, generally you're going to be mistaken. And the reason why is because it's non-farm payroll. And generally what will happen is non-farm payroll will create this scenario where it whips up, takes out the highs, takes down the lows, and it goes right back to the middle. Okay? By having this understanding in your day trading models, understand that when you go into keynote speakers, FOMC, rate announcements, and non-farm payroll, this is the environment that generally, this is what you see. Okay, very rarely will it end up being a trending market for intraday. This is the environment you see. So this is the reason why we try to avoid trading those environments for day trading. It doesn't mean we get out of our short-term trades or our long-term positions. It just means that we try not to trade intraday on these conditions because you end up getting whipsawed and it goes right back to the middle of the range and closes there for the day. And it's very frustrating for folks that try to get in there and do trades, especially if you're looking for a continuation, because you end up getting pulled back and trapped in the middle of the range. So let's take a look at some examples of what this looks like and how we can apply it. Okay guys, we're looking at the British pound USD, or as we call it, the cable. And I want you to see that the patterns that we're talking about here is limited again to turtle soups and first returns to order blocks that are optimal trade entry. We have a low here that's pierced right in here, and I want you to notice that the opening and close that takes place after that. If we're only looking at the old range highs, in other words, we're looking as a pierce below this low here, we want to be looking to be a buyer, turtle soup, long entry, because we believe that there's most likely a bunch of stops below this low, and on a short-term basis we could see market run the opposite direction. Now there's two range highs that you would be considering here. You could look at this range high or swing high back here, okay, and we can also look for this one as well, okay, here and here. Now, what does that mean? That means, well, we're going to be day trading with the expectation that the daily candles, because we're looking at a daily chart here, the daily candles are going to expand up until we get to this high, and if we show willingness to go through it, it's going to expand to this high here. Okay. Now, what does that look like as it relates to the open, high, low, close bars? Well, if you look at what was going on, and it may be a little difficult to see, but we have the down move here, turtle soup entry. The next day, what are we going to do? We're going to see the opening price and then an initial move lower. Okay, the opening price and then move lower. That's the Judas swing we're looking for. And then we want to see range expand to the upside and have it up close. The very next day, we see the same thing happen. We have an opening, a down move, then a rally up. It doesn't get to that range high yet, but it does have an open. I'm sorry, yeah, open that's lower than the close. Okay, and an intraday range exiting out at a profitable objective, very likely here. Very next day, same thing happening. We have an opening price, a move lower, Judas swing lower. We want to be buying. Okay, what does it do? Expands to the upside, runs into the high. Okay, now what do? We wait. We wait. We want to see new opportunities form. Okay, we go into a new week here. Here's Monday. We don't like to trade on Monday. Tuesdays and Wednesdays we've learned in the Sniper series, we learned in the Precision Trading series, we learned in all the other ICT courses. When I teach time and price, day of week phenomenon is absolutely paramount. On Monday we have a mixed day. On Tuesday we have an open, a decline, and then a rally up close. Okay, on Wednesday we have an opening, a decline, and ends up going lower. Initially we see a rally up and then it has a down close. On Thursday of that week, okay, we're still consolidating around that low. I'm sorry, that high here. So what are we looking for still? We're looking for conditions where there's an opening, a drop down, a Judas swing, and a rally up. Okay, and we're going to continuously look for that, okay, to the upside, expanding until we get to this range high. Now, if this was to break down and start going lower, obviously we would have to nix this whole idea here. But when we're looking at higher time frame daily charts like this, we monitor institutional order flow, okay? And we also look for turtle soup environments, okay? We had a consolidation in here. Price runs away from it, okay? Even if we miss this buying opportunity on an intraday basis, when price dropped down again into this order block here, right here, this very next day, you're looking to be a buyer at London because it's going to open, anticipate a drop down or a Judas swing into what? The order block itself, run up, okay, and then it's an up close. Same thing the next day. It opens, trades down, creates a Judas swing, expands to the upside, takes out the high, okay, and you continuously map out areas of where you would expect that expansion on the daily chart to explode and move higher. We have an order block here. Okay, we move back down below this high. You'll be able to see the order block, the effects of the order block on future trading. So price comes down, trades right into the order block. So once it trades into it on a daily chart, we anticipate what forming the next day? An open, down, buy it with a range expansion to the upside, up close. Okay, same thing have here. Okay, we have a down candle before the big move up. Okay, price comes down. We wait till it trades into the order block again. The very next day, we're looking to do what? We want to be a buyer. Well, we have a Sunday's candle in here. We got to wait. Opening doesn't give you much of a move lower here, but does have an up close. And the same thing happening here. We have a opening, a down move initially. We want to be buying on that environment. Okay, and wait for expansion on the upside. What are we waiting for to trade up to as we're buying each day? Day trading. You're waiting for the high to be retested as it does here. Okay, you're challenging old highs. That's the range you trade in for day trading. Okay, the same thing happens here. Price starts to recede a little bit. Maybe you didn't do any more buying in here. Okay, maybe you moved to the sidelines. You're not taking any more action yet. Price drops down into the order block again. Okay, down candle before the move up. Okay, you want to be buying here. So how do we do that? The next day, when we looking for an opening, down move, and buying. Okay, we come off of the lows. Maybe this would have been a losing day. Maybe it's a missed opportunity. Who knows? We don't know. Again, we're just looking for the overall tendency for these environments to create and repeat themselves. Opening, drop down, range expands into the upside, up close. Same thing. Open, drop down, range expands to the upside, up close. We have another retracement lower. Okay, moves back down into the order block that was used here again. Same thing happened. Once we do that, the very next day, we expect to see what happened. The opening price, a drop down, okay, and then rally up, a range expansion. Same thing. We continue. What are we looking? What are we waiting for? And why? When do we not want to do this any longer? When we start getting up to the high of the range here, expand that out here in time, right here on this day. Now, I may not have taken the next one here going long, but all the way through here, you're looking for that range to be fulfilled. So you're going to be looking to be a day trader on the upside, buying with institutional order flow on the daily chart. Okay. Now, also notice when we have lows on the daily chart, it's important that you keep in mind that you're always anticipating turtle soups as well. And turtle soups are going to be in the form of highs and lows being breached. We have a low here. When that low was breached, okay, and price moved lower here, you would be buying in addition to it moving into an order block. That's a very high probability setup for day trading. The same thing happens here. We have a low and price moves below it again. And again, day trading is not everyday trading. It's day trading when it's the highest probable conditions. We have a low here where stocks will be resting. Price moves below that low. Turtle soup buy. It moves back into an order block. The order block is defined as is the sniper series and precision trading. So again, I'm not going to teach all that stuff here. If you haven't gone through those video courses, shame on you. You shouldn't be watching what you're watching now. Okay, the same thing happens here as well. Okay, when you have the low here, okay, and again, you're looking for bullish institutional order flow on a daily chart. Everything's moving higher. Price moves below the low, sweeps below. Look at the bodies of the candles. See how they're very respective of that low? But the wicks are dipping down into that, okay? They're running the stops, and then you want to anticipate what? Expecting the stops to be ran and price go the other way. waiting for what to be fulfilled? This range high. So having that in mind, if you have that as your upside objectives, in other words, what filters out when you no longer look for buys, just using price alone, no moving averages, none of that stuff's required, just looking at price. From down here, once we have that turtle soup environment, everything that we look for from an open, decline, rally, up, close, small little day, we're in consolidation. Next day, open, rally, I'm sorry, decline rather, and then rally, up, close, open, decline, due to swing, buy it, expands into the upside. Very next day, open, decline, buy it, expands right into the high. Okay, so you can see by having the ranges defined on your daily chart and studying. This is what I'm talking about when you guys are always hearing me hammer on you. You have to be studying the daily chart. You have to be studying the daily chart. You got to be looking at the dealing ranges. You got to look at where you're at in deference to institutional order flow. Are we looking for higher prices? Are we respecting bullish order blocks? Clearly, we're seeing respective order blocks, and we're seeing stops being scooped up, and when the stops are taken, it wants to rally higher. So it's only going to come back for the sell stops to take new buying on. Okay, and it's very important you understand that, because once you see this phenomenon repeat over and over again, yes, you're going to take losses, but you're not going to fear them, because you're going to be able to see that overall, look how many times we have up closes. Okay, and they're big ranges. They're not little things. They're big ranges, and you're getting near the low of the day with London and getting out near the London close. You're getting the lines portion of the move. Who cares if you don't get the very high or if you get the very low on the entry? It doesn't make a difference. You just need a lines portion of the move over a long period of time, and you compound your money, and it doesn't take long for you to develop wealth. So I want you to go through your charts, use these ideas, build the framework that we're describing here, and incorporate everything that was always shared in all the previous teaching tutorials, because it's not important that I teach all that again. You don't need that. You've already been exposed to it. But apply what we've shown here, and I think you'll find very easily what you've been looking for as it relates to day trading. So with that, guys, I wish you good luck and good trading.